Welcome to a deep dive into the fascinating and, let's be honest, sometimes head-scratching world of personal property rental taxes.
We're going beyond just, renting out your vacation home for this one.
Right. Think vintage cars rented out for movies.
Or that awesome power tool your neighbor keeps borrowing.
Ooh, yeah.
Bruh.
Or even like a whole fleet of construction equipment. You ready to uncover some tax secrets?
You'd be surprised how many people miss out on potential savings with this stuff.
Totally. Or get tripped up by unexpected rules.
The IRS doesn't just lump all personal property rentals together.
That's right.
There are nuances to uncover that can make a real difference.
And that's what we're here for.
Right.
So our source material lays out three main ways the IRS looks at these rentals. As a business.
Right.
As a casual for-profit activity.
Right.
Or as a not-for-profit hobby. These aren't just, different labels.
No, not at all.
They come with totally different tax implications.
Yeah.
What's the first thing someone should consider to figure out which category they're in?
It all boils down to intent and regularity. Are you renting out this personal property with the primary goal of making money and doing so consistently?
Okay.
If so, you're likely running a rental business, even if it's, on the side.
Makes sense.
This means treating it like a business on your taxes, too.
Okay, so using one of the examples from our deep dive prep, let's say you have a collection of vintage cameras. If you rent them out for a few photo shoots each year, that might fall under the casual for-profit umbrella, right?
Exactly.
You're earning some income, but it's not your main gig.
And the IRS treats that differently than, say, a professional photographer who rents out equipment as part of their regular business operations.
Ah, okay.
Those occasional rentals are about, putting some extra cash in your pocket and not building a business empire.
Which is totally fine.
Of course.
But how does that distinction actually play out when it's time to file taxes?
Well, for those casual for-profit activities, you'll report the income on a different section of your tax form Schedule 1, to be exact.
Cool.
The good news, you usually dodge that extra self-employment tax that comes with running a full-fledged business.
That's a win.
Yeah.
Now, what about the folks who lend out personal items occasionally? Maybe for just the cost of gas money or a small favor.
Right.
Like, if I lend my lawnmower to a neighbor for a six-pack, that's not exactly a money-making scheme.
You're hitting on our third category, not-for-profit, or what the IRS affectionately calls hobby activities.
Okay.
The primary goal here isn't to line your pockets. It's about, sharing resources or helping someone out. Now, there are some specific rules about deducting expenses for hobby activities that we'll delve into a bit later.
Okay.
But the key takeaway is that the IRS sees these as fundamentally different from a business venture.
So we've got our three main categories. Businesses, consistently generating income.
Right.
For-profit side hustles for a little extra cash.
Sure.
And hobby rentals that are more about, lending a helping hand. What's next on our deep dive agenda?
This is where things get particularly interesting and complex. We're going to tackle what happens when you rent your personal property to your own business. Trust me, this is where things get really juicy. Imagine this. You've got a successful bakery.
Okay.
And you decide to rent out your prized, commercial-grade stand mixer to the business.
Okay.
Seems simple enough, right? But buckle up, because the tax implications, they hinge on how your business is structured.
Okay, so we're talking about sole proprietorships versus partnerships versus corporations, that kind of thing.
Right.
Why does that make such a difference?
It all comes down to how the IRS views the relationship between you and your business.
Okay.
Let's say you're a sole proprietor or running a single-member LLC.
Right.
In the eyes of the IRS, you and the business are essentially one and the same.
So renting your stand mixer to your own business in that scenario is kind of like moving money between different pockets of your own pants.
Exactly.
It's all your income at the end of the day.
Precisely. But things get a bit more intricate when we step into the realm of corporations, partnerships, or multi-member LLCs.
Okay.
These structures are considered separate entities from you personally.
Ah, so now we're talking about two distinct parties, me, the individual,
Right.
and the business I've created.
Yes.
And any transactions between the two, like a rental agreement, need to be handled accordingly.
Precisely. Now, within this world of separate entities, we've got even more layers to peel back.
Oh, boy.
Let's start with pass-through entities like S corporations, partnerships, or multi-member LLCs.
Pass-through entities, that sounds like we're about to dive into some accounting jargon.
No jargon, I promise.
Okay, good.
Pass-through simply means that the income and expenses of the business pass through to your personal tax return.
Okay.
You're taxed on your share of the profits, even if those profits stay within the business.
Go ahead.
So if you're renting that stand mixer to your S-Corp, for instance,
Right.
your business deducts the rental payments, and you, in turn, report that rental income on your Form 1040.
So in essence, it's like you're paying rent to yourself, but with some, specific tax implications to keep in mind.
Exactly.
Now, what about C corporations? Our prep materials highlighted them as a potential, tax strategy goldmine.
They certainly can be.
Okay.
Now, remember that dreaded double taxation issue we often hear about with C corporations?
Vaguely. It's like getting taxed twice on the same income.
Yes.
Once at the corporate level and again when it's distributed to shareholders.
You got it. Well, renting personal property to your C Corp can be a clever way to potentially lessen that sting.
Okay.
Here's how it works. The corporation gets to deduct those rental payments as a business expense, which can lower their overall tax burden.
Right.
And you, as the owner, only face taxation once on that rental income when you receive it. It's a win-win.
That's brilliant. Our source material actually had a great real-world example about this involving a dry cleaning business owner named Mark.
Right.
He rented some equipment to his C Corp and was able to strategically manage his tax liability. But I imagine there are some rules to follow to make sure everything's above board of the IRS.
Absolutely. Just like with any business transaction, documentation is key.
Of course.
You'll want a formal lease agreement outlining the terms of the rental, just like you would with an outside party.
Right.
And crucially, those rental payments need to align with fair market value.
Right.
Don't try to inflate those numbers just to shift income around.
Right.
The IRS is pretty savvy when it comes to sniffing out those sorts of maneuvers.
So keep it clean.
Yeah.
Keep it documented, and make sure those rental rates pass the sniff test. This is all great advice, but I have to admit, I'm starting to see why people get overwhelmed by taxes.
It can be a lot.
It's like navigating a maze.
It is. And
Yeah.
that brings us to a potentially tricky aspect of all this, the self-rental rule.
Ooh, that sounds ominous. What kind of tax trap are we talking about here?
It's not quite a trap,
Okay.
but more like a curveball the IRS throws your way in certain situations.
Yeah.
The self-rental rule comes into play when you're materially participating in the business you're renting to.
Okay, pause right there.
Okay.
Materially participating. We need to define that.
Sure.
What does that actually mean in this context?
Good catch. In simple terms, it means you're actively involved in running the day-to-day operations of the business.
Okay,
Not just a silent partner collecting checks.
right.
You're wearing multiple hats.
Got it.
Business owner and landlord, if you will.
So how does this material participation thing impact things from a tax perspective?
Well, it creates a bit of a split personality for your rental income.
Okay.
Here's the gist. If the rental activity is profitable,
Right.
the IRS views it as non-passive income,
Okay.
which is generally a good thing.
Right.
But, and this is where it gets interesting,
Oh.
if the rental activity results in a loss,
Okay.
it's considered a passive loss.
Oh.
And those passive losses can be trickier to deduct on your taxes.
Oh, I see.
There are limitations involved.
So it's like a heads I win, tails you lose situation with the IRS.
Kind of, yeah.
If the rental income is looking good, they're happy to go one way. But if it's not so rosy, the rules change.
That's a simplified way to put it, but you've got the right idea.
Yeah.
However, like with most things tax-related, there's a potential workaround to this self-rental conundrum.
Okay, I'm intrigued.
It's called grouping.
Grouping. Like grouping together my favorite pens on my desk. How does that apply to taxes?
Not quite the same kind of grouping, but I like your organizational spirit. Think of it this way. Under certain conditions, the IRS might let you group your personal property rental activity with your main business activity for tax purposes.
So instead of treating them as two separate entities with potentially conflicting rules,
Right.
we're merging them into one big happy tax family. When would that be allowed?
Exactly. Our source material points to a couple of common scenarios. One is if the rental activity is considered insubstantial compared to the scope of your main business operations.
Mm.
For example, let's say you're renting out a small portion of your office building to your business.
Right.
Because the rental income is relatively small compared to your, primary business activity.
Right.
You might be able to group them together.
So in that case, the rental income and expenses would be treated as part and parcel of the main business activity,
Right.
bypassing the potential headaches of the self-rental rule.
Exactly.
That makes sense.
Yeah.
What's the other scenario where grouping might come in handy?
The other common situation is when you have the same ownership percentage in both the rental activity and the business.
Okay.
This usually comes up with like partnerships or multi-member LLCs.
Right.
If your ownership stake is identical across the board,
Right.
it strengthens the case for treating them as a unified entity for tax purposes.
It's like the IRS saying, okay, we see you're equally invested in both sides of this, so we'll let this grouping slide. But I'm guessing there are some caveats or exceptions we should be aware of.
Always caveats. One important one is that, generally speaking, you can't group real estate rentals with personal property rentals.
Oh, okay.
So if you're renting both a building and, say, a piece of equipment to your business,
Right.
those would likely need to be treated separately.
Okay, so we need to keep our real estate and personal property rentals in their own respective lanes.
Exactly.
Got it. Any other exceptions to keep in mind?
Here's a big one, that grouping benefit we just talked about. It typically doesn't apply to C corporations.
Oh, right.
Remember how we said C Corp can be advantageous for personal property rentals because of that separate entity status?
Right.
Well, that also means they miss out on the potential perks of grouping.
So it's a trade-off.
Right.
C Corp gets some unique advantages, but grouping isn't one of them.
All right.
It's all about weighing the pros and cons based on your specific situation. We've covered a lot of ground in this deep dive.
We have.
For someone who might be feeling a little overwhelmed right now, what's the most important thing to remember?
You're right, we've gone deep. If there's one key takeaway, it's this. Clarity is paramount. Don't just assume you know how these rules apply to your personal property rentals.
Right.
Take the time to figure out which category your rental activity falls under.
Okay.
Business, casual for-profit, or hobby, and understand the nuances of renting to your own business.
And don't be afraid to seek out, expert guidance. A qualified tax professional can be invaluable in helping you navigate these complexities, especially when dealing with things like self-rental or incorporating your business.
Absolutely. Think of it as an investment in your financial well-being.
Right.
A good tax pro can help you maximize deductions, minimize liabilities, and most importantly, sleep soundly at night knowing your taxes are in order.
Sound advice.
Oh,
Well, I don't know about you, but I feel like we've cracked the code on personal property rental taxes today.
we did it.
From vintage cameras to stand mixers, we've explored the ins and outs of making those rentals work for you, not against you.
It's been a pleasure diving into these fascinating details with you.
Likewise.
Remember, knowledge is power, especially when it comes to navigating the intricate world of taxes.
Couldn't agree more. And for our listeners, this is just the beginning.
That's right.
We've equipped you with the knowledge and insights to tackle your personal property rentals with confidence. Until next time, keep exploring, keep learning, and keep those fascinating tax questions coming.